a nation of unimaginable wealth, yet one caught in its own trap. In reality, Australia remains among the countries with the highest personal wealth in the world. The average Australian adult holds around $516,640 in net assets. Moreover, the country maintains an exceptionally high standard of living, with a GDP per capita ranked among the global top. Recent data from Worldometer places that figure at about $70,340. And here's what's remarkable. Although it is a wealthy nation, Australia is caught in a unique paradox, a developed economy that still carries the traits of one built on resources and real estate, a model that has caused many nations to decline once their boom years passed. On the surface, everything seems perfect. But behind that prosperity lies a fragile structure. Australia is heavily dependent on the Chinese market, which accounted for around 32% of its total goods exports in 2023. A nation seen as one of America's closest allies, yet sustained by demand from Beijing. It's a position both strong and weak, an economy that appears solid, but could be shaken by a single gust of geopolitics. In a world that is being reshaped, Australia resembles a tightrope walker, wealthy and radiant, yet one misstep could bring everything crashing down. The most frightening thing for any economy isn't crisis itself. It's the illusion that everything is still fine. External pressures are tightening. Global commodity prices fluctuate, interest rates continue to climb, and China, Australia's largest export market, is slowing down. Together, these forces have made the economy harder to control than ever before. We may think we're still on course, but in truth, we're steering a giant ship into ever shallower waters. Just because the cracks aren't visible doesn't mean they don't exist. Look at the housing market. In Sydney and Melbourne, median home prices have surpassed 1.12 million Australian dollars as of early 2025. That's no longer a sign of success, it's a symbol of pressure as the dream of owning a home drifts further out of reach. And yet, Australia still shines in many respects. Enormous natural resources, a strong trading position, and an almost 7-year streak of trade surpluses, reaching about 3.94 billion Australian dollars in September 2025. But the bigger question remains, where is Australia really headed? And can it fix these deep-rooted weaknesses without sacrificing the stability it has maintained for more than 3 decades? Like a lottery winner who spends everything without investing for the future, Australia may be falling into that very trap. Nature has been generous to this land. Minerals, coal, gas, iron, gold, lithium. Enough to sustain a population of just over 26 million. In theory, simply selling the land's bounty could keep the nation wealthy for generations. But easy money always comes with a hidden cost. Australia's export structure remains dangerously narrow, dominated by raw materials and unrefined agricultural products, while advanced manufacturing and technology sectors remain faint shadows. Selling raw resources brings quick profit, but adds little to domestic production. It sounds appealing, little effort, steady income, yet for a nation, it's a risky formula. When exports make up such a large share of GDP, the economy becomes hostage to global commodity prices, trade tensions, and the health of economies thousands of kilometers away. All it takes is a drop in demand for iron, ore, or coal, and growth can stumble overnight. Adding to this, Australia's second largest export is coal, a fuel much of the world is steadily abandoning in the pursuit of sustainability and lower emissions, while cheaper renewable alternatives are becoming increasingly viable. According to the Department of Industry, Science and Resources, the value of Australia's resource and energy exports is projected to fall from around 415 billion Australian dollars in 2023 to 2024 to 387 billion Australian dollars in 2024 to 2025, a clear reflection of the risks tied to such an undiversified growth model. Another consequence of over-reliance on natural resources is the risk of corruption and weak economic diffusion. When a country's main revenue comes from easy gold, oversight, fair distribution of profits, and reinvestment into the domestic economy often get neglected. If we judged Australia purely by its goods exports, the picture might seem bleak, a resource-dependent economy. But once we include services exports, the story changes dramatically. Roughly 1/3 of Australia's total exports come from intangible sectors such as education and tourism. Economically speaking, every dollar spent by a foreign visitor, whether it's for a coffee, a hotel stay, or a university degree, counts as an export because that money flows from overseas directly into Australia's economy. Even so, Australia has managed to stay relatively stable for decades, largely thanks to its strong institutions and governance system. But even a solid framework can't shield the country from two major mistakes. First, Australia has failed to tax its natural resources effectively to turn what's heaven-given into collective wealth. Data from the Australian Taxation Office and independent reports show that many large gas and coal corporations operating in Australia have paid little to no significant corporate tax from their extraction activities. Meanwhile, according to the Australia Institute, total subsidies and incentives for the fossil fuel sector at both federal and state levels reached 14.5 billion Australian dollars in the 2023 to 2024 fiscal year. A staggering figure that suggests the government is still feeding an industry the rest of the world is trying to leave behind. Second, the country's chronic pain, the housing market. Home prices in Australia's major cities remain astonishingly high, and rather than easing the pressure, current measures have yet to reverse the trend. Real estate has become a kind of economic religion for Australians. According to First Links, many Australian cities now rank among the most expensive housing markets in the world, far outpacing average income levels, a clear signal that the imbalance has gone too far. To grasp just how expensive housing in Australia has become, let's compare Sydney with some of the world's most famously costly cities. According to Demographia International Housing Affordability 2024, Sydney now ranks as the second least affordable housing market in the world, trailing only Hong Kong, a city with several times its population density. Even when compared with global giants like London, New York, or Tokyo, Sydney still comes out on top, or rather, over the edge, when measured by the ratio of house prices to household income. In London, it takes the average resident about 12 years of income to buy a home. In Sydney, that number exceeds 14 years, a figure that borders on absurd for a nation with vast land and a relatively small population. Immigration, services, and the lifelines keeping Australia afloat. First of all, Australia is a multicultural society, open to immigrants and more attractive to newcomers than most other developed nations. Most migrants come for the high wages, strong welfare system, and safe living conditions. And of course, they all need a place to live. This has unintentionally fueled the housing boom, pushing demand higher. But it isn't just migrant workers. A smaller yet notable group consists of wealthy foreigners from other developed countries drawn to Australia as one of the most livable nations on Earth. They flock to Sydney, Melbourne, or Perth to buy property, invest, or simply enjoy a life of mild weather and stable laws. In response, the Australian government imposed a 2-year ban on foreign home purchases, a move that sounds reasonable at first glance. Yet, in practice, foreign investors account for only a tiny share of total transactions, and the ban doesn't apply to temporary visa holders. That might sound reasonable. People who already live here, even temporarily, should be allowed to buy the place they call home. Or perhaps not. It's a topic that sparks fierce debate. But one thing is clear, this very loophole has encouraged a wave of international students to come to Australia, not only for education, but sometimes as a path into the property market or the labor force through lenient visa programs. To be fair, the government has cracked down on diploma mills, institutions set up solely to help foreigners obtain student visas. Yet even the country's most prestigious universities have grown heavily dependent on income from international students. At many institutions, over 40% of total revenue now comes from foreign tuition fees This means that policies like banning foreign investors from buying homes end up being only a minor inconvenience, not a real solution to the housing crisis. In reality, Australian real estate has become a global asset eagerly sought after by both domestic and international buyers. And to make matters worse, Australia's tax system continues to fuel this property obsession. As many affluent Australians openly say, if you don't own at least one investment property, you're missing the biggest opportunity of your life. This mindset doesn't just promote property speculation, it also drives massive household borrowing. As of the first quarter of 2025, Australia's household debt to GDP ratio stood at around 113%, the second highest in the world. In other words, while Australia's public debt may appear healthier than that of many other advanced economies, its private debt tells a much darker story. And most of that debt doesn't come from clever investment strategies, it comes from ordinary people borrowing simply to buy a home. For most Australians, the pressure to own property feels inescapable. Renting isn't much of a relief. Rental prices keep rising every year, closely tracking the surge in home values. Taking on a mortgage may be riskier, but paradoxically, it feels more secure. Because at least a mortgage ends one day, renting never does. Furthermore, housing in Australia has become so expensive that owning a home is now almost a prerequisite for retirement security. Without one, retirees must rely on exceptionally high incomes to cover living costs, especially as housing expenses continue to rise year after year. Unfortunately, instead of addressing the root cause, making housing more affordable, most government policies still focus on the demand side: grants for first-time buyers, tax exemptions, and financial aid for mortgage holders. Another key factor is income. Australians enjoy some of the highest average wages in the world, and even the minimum wage remains among the most competitive globally. As of July 1st, 2025, the national minimum stands at $24.95 per hour. Yet at the very top of the income ladder, the ultra-high earners who often drive major asset bubbles, Australia cannot compete with global hubs like Silicon Valley, New York, London, or Hong Kong. That means the demand fueling Australia's property market doesn't come from global billionaires, but overwhelmingly from domestic buyers. There's also a geographic paradox. Australia is the sixth largest country in the world, yet much of its landmass is desert or arid terrain. Most people choose to live in a handful of coastal cities where space is limited and real estate ranks among the most expensive on Earth. In rural areas, homes can be astonishingly cheap, but in cities like Sydney or Melbourne, prices soar to global extremes. At the same time, strict zoning regulations and complex planning approvals have made expanding housing supply nearly impossible. Politically, there's little incentive to change. Homeownership rates remain high, and Australians view their property as the foundation of personal wealth. Few want prices to fall, even those who don't plan to sell. Meanwhile, state governments have grown deeply dependent on real estate revenue, particularly from stamp duty, a transaction tax that can account for up to 25% of total state budgets during boom years. Originally intended to cover the administrative cost of recording new land ownership, it has now ballooned into a major pillar of state finance. And the construction industry, one of the country's largest employers, has little interest in lower home prices. Any decline would mean fewer projects, smaller profits, and job losses. The result is a self-reinforcing system where every stakeholder, citizens, governments, and businesses, has a reason to preserve the status quo, even though everyone quietly knows that the system is slowly tightening around itself. Most of the nation's current troubles don't stem from mistakes, but from the very strengths that once defined its success. When it comes to income equality, Australia sits around the global average, notably lower than Canada. But in wealth equality, it ranks among the best in the world with a net wealth Gini coefficient of 0.606, behind only Slovenia, Slovakia, Iceland, and Belgium, nations with generous welfare systems but far smaller populations. What's remarkable is that Australia has no inheritance tax, and yet wealth inequality hasn't ballooned as theory might suggest. Why? Because of two defining pillars of the Australian system. High homeownership, around 67% of Australians own a home. Mandatory superannuation funds, holding over 4.1 trillion Australian dollars in total assets. Together, these two factors have effectively lifted the floor for the middle class, making the gap between rich and poor appear narrower than it really is. But everyone owns a home doesn't mean everyone is wealthy. When every home costs a fortune, wealth itself becomes an illusion. Beneath those flattering averages lies a new form of inequality. Between the younger generation, burdened by debt and high taxes, and the older generation, who bought property decades ago for a fraction of today's prices. And while the picture may seem bleak, Australia still has all the tools it needs to fix these problems. The real question is, why hasn't it acted? As the nation approaches a major election, both political sides are promising solutions to every issue. But in truth, it's entirely possible that neither of them really wants to solve the problem at all.